Valuation of inventory. Inventory is always valued. Inventory is always valued at cost or net realizable value whichever is a lower. Net realizable value is a difference between market price and sales expenses. So we have to value inventory. Using the concept of lower of cost or net realizable value, whichever is a lower. So this is to be in line with the prudence concept, not to overvalue asset in the statement of financial position. So we will have to record the difference between cost and net realizable value, whichever is a lower. So market price, this is called the selling price. At times we have to make some adjustment with market price. That is, we will have sales expenses. Before selling the inventory, there will be some expenses, what we call sales expenses. It can be marketing expenses, or it can be expenses in case the inventory is damaged, and so on. So the difference between market price and sales expenses will give us net realizable value. Now let us see an example how to value inventory using the concept of net realizable value, that is lower of cost and net realizable value. Example, we have products A, product B, product C. Cost. This is the cost 200. It has been bought for 200, and this one has been bought for 400, and this one has been bought for 600. Market price. It can be sold for 350, and this one can be sold for 500, and this one can be sold for 800. Now we have sales expenses. Part of the inventory is damaged. We have to incur some expenses. Let's say expenses $200. And here also we will have to incur some expenses in order to sell product B. And here we have to incur some expenses, let's say 100. Now, this is given, we have to calculate the value of inventory using lower cost or net realizable value. First, we will have to calculate the net realizable value. 350 retire 200, ça nous donne 150 net realizable value. This one 200 and this one 700. So now we have to apply lower of cost or net realizable value. Lower of cost or net realizable value. This is a lower, right? A lower of cost. Here it costs 200 and net realizable value 150, which is lower, 150. Here we have cost 400 and net realizable 200. We will have to take 200. Here we have the cost 600 in net realizable value 700. We will have to take 600. So valuation of inventory 950. In the statement of financial position, we will have to record inventory at 950. So this is how we use the concept of lower of cost or net realizable value. Inventory is always valued at cost or net realizable value, whichever is the lower. Net realizable value is the difference between market price and sales expenses. Cost of product A 200. We are expecting to sell it for 350, but we have some sales expenses amounting to $200, so it could be sold for 150. So in this case, we will have to take the lower of cost or net realizable value for the valuation of inventory. In this case, we will take 150. And 400, the cost, we have bought the stock for 400, stock B, and we are expecting to sell it 500, but we have to incur some sale expenses 300, and now it can be sold for $200. So lower of cost, we have 400 and 200, so we will have to take 200. For product C, we have the cost $600. It has been bought for $600, and market price $800. We are expecting to sell it for $800, expected selling price, and we have to incur some expenses $100. So it can be sold for $700. So 700 net realizable value, lower cost 600. The cost is 600, therefore we will have to take 600. So we have to add 150, 200 plus 600. This will give us $950. This value of inventory will be recorded in the statement of financial position. Thank you very much for your attention.